This RSM Tax Week presentation is Workforce Changes Are Becoming Permanent. Now what? At this time, I'm pleased to turn our call over to our first presenter, Jeremy Rubishko. Jeremy?
Good morning, everyone. My name is Jeremy Rubishko. I am the national leader for tax credits, incentives, and accounting methods, and I'll be serving as a moderator today for my three esteemed colleagues who I'll let introduce themselves before we kick things off. So Ann.
Morning, everyone. I'm Ann Bushman. I lead our federal tax compensation and benefits group at RSM.
Okay, Dominique.
Good morning, Jeremy. Good morning, everyone. Today, I'm Dominique Wadois. I'm a senior director at RSM, and I'm the Northeast region leader of Global Employer Services.
Thank you. And then finally, Brian.
Thank you, Jeremy. Good morning, everyone. I'm Brian Kirkell. I'm a principal in Washington National Tax, specializing in state and local taxation.
All right, so we're going to be able to talk about today's conversation from a domestic, international, and then 50-state perspective. So going over our agenda today, we're going to start with talking about what the current landscape is, and then move into managing risks and employment options, how this overlays with compensation and benefits. And then we're going to take a deeper dive into how all the different states are dealing with the changes in workforce. And then finally wrapping up with approval process methodology and framework and governance setup, excuse me. So let's start out with a polling question. What best describes your company's return to office policy? Our employees can now work remotely from anywhere. Our employees can now work remotely anywhere in the United States. International work requires pre-approval. We will require all employees to return back to the office once we're comfortable with the pandemic being over. And we have not released any formal guidance yet, and we're reviewing and approving remote arrangements as they arise. So we'll give everyone a few minutes. We're at about 42%. So we'll give folks a little bit of time to get their answers in so we can all get our CPE credit. All right, so we're at about 90%, so we'll keep it open for 10 more seconds, and then we'll see what the results are. Okay, 3, 2, 1. All right, so as you can see, it's kind of an even mix. Some folks have answered employees can work anywhere. Others are saying no guidance, but we're dealing with it as it comes, while others are kind of in the middle with coming back when the pandemic is over and flexibility. So that's good because we're going to be addressing all these areas. Okay, so the current landscape. So Ann, maybe I'll start with you. Before we get into a lot of details, maybe let's define, what is a remote worker for purposes of today's conversation, and what situations are we going to be discussing today?
Yes, good point, Jeremy. We're really talking about remote workers in a pretty broad sense today. I would say let's think of it as any worker who isn't coming to the office necessarily or your employer location. So for a lot of people, they might be in a different location than they were pre-COVID. If you're hiring new workers, though, now as time passes, some of them maybe never reported to an office. So it's anybody working outside of your office or main location, which is, as we saw already in the polling results, it's becoming pretty prevalent. And there's going to be a number of considerations that we talk about this morning. You'll see on the slide, even someone in the same country and same state is going to have some issues. Obviously, the number of issues increase as we move up and cross state lines or cross international borders, but we'll talk about remote workers in all of those senses.
Okay, thanks. So Dominique, Ann hit on international remote working, and we have organizations, as we saw in the polling. Some are really itching to get back together. Others have a lot of flexibility and are in a hybrid model of remote work. What are your observations about the current market trends with remote work?
So, Jeremy, trends show that flexibility and hybrid work will define the post-pandemic workplace. And over the past year, I would say that we can all say that no area has undergone more rapid transformation than the way we work. While some remote work arrangement may present low tax implication to an employer, such is the case for an individual who is working remotely from the same country or the same state, you would need to really perform a detailed review when an individual has moved to a different foreign tax jurisdiction for a period of time, and that may trigger payroll, corporate, or tax implication. While many organizations were really reactive in 2020, we have now observed, and I have observed it with my client, that many businesses have now put approval processes in place prior to really allowing an individual to work from a different tax jurisdiction.
Yeah, I think that those are great observations, and I think it helps us move on to our next topic. So as companies are evaluating and moving into their new work arrangements, as you've seen in your clients, what's been the biggest eye opener for organizations when it comes to entering into these more remote working relationships?
So I'm going to take this question, Jeremy. So I would say that by now, many organizations have discovered that really one single employee may create a risk for their organization. An employee may create what we call a permanent establishment, which may require an entity to register. A home office working arrangement in another location may create a permanent establishment if the arrangement becomes long-term. In terms of transfer pricing, an employee activity may lead to corporate profit attribution in the location where they are based. In terms of employer obligation, an employer may now have a withholding tax and a social tax obligation. Also, when we speak to organizations, we need to point out to them that we need also to look at the individual tax aspect, and an employee tax residency may have shifted, and it may impact his net pay as well as his social security status, which may have shifted. The employee may also not have the right to work if they are a foreign national in the host location. So this is like the first area of focus is what do we need to do from an immigration perspective? And the final point I would make on this how to manage risk is that an employee may create also exposure in terms of labor law and local regulation, which really need to be addressed and researched.
Yeah, that could be a big surprise if all of a sudden the employee isn't eligible to work in a particular location, or you create permanent establishment, and it requires, much more when it comes to reporting and tax compliance related to that. It could be a big cost. And that's why we're going to get into approval process and governance as we move on through. And maybe come back to you on the domestic side. From a U.S. domestic perspective, how big are these risks? Companies, if I put myself in the chair of an owner or CFO, there's a lot of different things going on, a lot of regulatory changes. How much time and attention should be paid to managing these risks, both domestically and internationally?
Well, it's obviously going to differ by employer depending on your facts and maybe how much has shifted within your workforce. But as you can see on the slide, there's certainly a lot more risk out there than just the tax risk. Dominique mentioned one employee going overseas could have a permanent establishment issue. Similarly, one employee sitting at home could have a data privacy issue that if somebody gets access to your data, that becomes a huge risk with just one employee. So it really matters what that situation is, how many employees. When we shift to looking at a tax perspective, workforce is a huge component for many businesses. So it's definitely important to consider, where are your employees? What on this slide is open to risk depending on those employee situations? And it's not always going to be a measurable risk, but at least sitting down and thinking about it, you have a more educated way of assessing whether it's something that you want to mitigate or not. Certainly the business has to run, and you're going to sometimes make business decisions to live with a certain level of risk. But if you haven't assessed the risk at all, you don't know how big it is and whether it makes sense to try to mitigate it or not. So I guess that's a long-winded answer to say that the risk level is going to differ by company. Some cases it might be small, but I think everyone would be surprised when you consider all these categories, how quickly it adds up for even just a couple of people.
Right. Yeah, there's the tax side of things, but then, as we know, I mean, data and employment law and such are also very key areas that folks have to manage as they're determining what their workforce of the future looks like. So let's maybe switch gears. And Dominique, I want to come back to you on international remote workers. You know, when we talk about risks, you know, what are the key factors in assessing risk from an international remote work arrangement?
That's a very good question, Jeremy. I think usually the conversation that I have with my client on this topic is that the key factor, I would say, is whether an organization as an entity in the location where the employee is going to work. And the simplest route would be to transfer employment to this host entity, if it is the case. And that would ensure that the employee is seconded to the right location, is paying the tax and the social security to the correct tax authorities, and as well as the employment benefits are provided where they are needed. However, the situation becomes more complex when there is a lack of corporate presence in the new location.
So there's a lot of things to consider. Have you seen a standard approach to setting up international remote workers, Dominique, in the last few years?
So I would say that a common arrangement is to have the employee on a contract and a payroll in one country, but working in another location. This arrangement may seem the simplest approach, but in many situations, you still need to ensure that you are remitting individual income taxes and social security taxes as needed in the host locations. Benefits delivered in the home country may not be of use to an employee who is now living in the host location, especially in terms of healthcare. Mandatory payroll and tax withholding will need to really be managed in the host location, usually for the setup of what we refer to as a shadow payroll. So this, of course, when it comes to shadow payroll, involves greater administration and also unplanned cost. Variances in rate of pay between the base country and the host location may come very often as a surprise if it's not reviewed and benchmarked.
Okay. So Dominic, maybe one more question for you. You know, is there a certain type of employee that's not a good candidate for an international remote work arrangement?
That's also a very excellent question, Jeremy. And so I would say an international remote work arrangement may become a challenge when you have a remote employee who is a senior executive in the host location. So that will trigger a close review of possible permanent establishment exposure that will need to be performed. But if you have junior staff who is providing support in a low-risk location, it may be more suited for an international remote work arrangement, I would say.
Okay, great observation. And anything more you want to add on this topic?
I think probably just from what I see on the domestic side and thinking about international remote workers is that keep in mind it isn't always just a 1-year look either. Some of these employees who might cross international borders may have long-term incentive or equity incentive that have a several-year look. And so switching countries at any time within that could have an impact, not even today, but maybe a few years down the road.
Okay. So maybe let's move to our next topic, which is compensation and benefits review. So Anne, maybe start with you and your observations here on compensation for remote working arrangements.
Yeah, absolutely. And I would say this definitely applies to remote work arrangements, just given sort of the great resignation and the tight labor market right now. A lot of these concepts may apply across the board, even if you don't have a significant portion of employees going remote. But companies are really revisiting their entire compensation philosophy, both compensation levels and the benefits offered. So we'll talk about these a little bit more. Both for compensation, employers are thinking, what is the right level of base pay? If I'm giving flexibility in location, can I pay less because the employees are valuing that flexibility, or maybe because they chose a location with a lower cost of living? Alternatively, I'm saving rent and occupancy costs maybe on my side, so should I share that with the employees and pay them more? So a lot of employers, I don't think we're anywhere near settled on what the geographic pay differences might be for some of the same positions. From a federal tax perspective, obviously pays pay. It's going to be taxable compensation. We're going to set the state differences aside for just right now. But then if we move from compensation into benefits, there's really a couple of buckets of benefits to consider. The first is reimbursement policies. These have specific federal tax consequences, both on what's tax-free to the employee and what's deductible to the employer. So here, it's really a business consideration, what expenses the employees might be incurring that you want to choose to reimburse, and do your policies reflect that? You can reimburse any type of expense, and then the question is just, do I have to tax the employee on that? The general presumption is payments or benefits to employees are taxable unless there's a specific exception that we fit within. So one of those exceptions that we dealt with a lot in 2020 was Section 139 that allowed tax-free disaster-related reimbursements. It's possible as we move on that something might still qualify as a disaster-related, but it's also possible that some of those same things might be working condition fringe benefits that are tax-free, but it's definitely something to look at. What do you want to reimburse, and consider whether it's tax-free or not as the facts change. For example, home office equipment. Last year, there may have been a strong argument that I had to get people set up at home and working now, so that was disaster-related and definitely tax-free. Some of those same things are ones that might be working condition fringe, but they may not if it looks more like a personal expense now. So just considering what you're reimbursing there. Travel expenses is really another ballgame. What's considered travel for federal tax purposes is based on being away from your tax home. Tax home is your primary work location, not necessarily your residence. So even if you know where your employees are, have you analyzed whether their tax home shifted to a different location, and what is a commute now might be different than what their commute was before. Again, doesn't mean you can't cover it. It just means the tax consequences might be different. Commuting expenses is one that, unfortunately, after the Tax Cuts and Jobs Act now has a double hit. It's taxable income to the employee and not deductible by the employer. So really reassessing that, and this is one, depending on your number of workers, where the dollar level can add up quicker than you might realize if it's never been assessed. Another category is meals. Are you covering certain meals for employees at home where the way the rules apply might be a little bit different than if you had provided a meal on your employer premise before? We also have different rules. So it's not only facts changing, it's also the rules have changed, where we have a temporary 100% deduction for meals provided by a restaurant. But you have to carefully look at the guidance and know, are we within that exception, or do we still have a deduction limitation on certain meals being provided? So then if we move
maybe,
into, oh, go ahead.
maybe before we move into some perks, as the landscape is changing, how important is documentation? And I've had some conversations where employees just want to give people a stipend essentially, or an allowance, let's call it, for certain things. What's your thoughts on that?
I think documentation is going to be pretty vital. I mean, especially when we see some of the legislative changes going through with an enforced IRS budget potentially. I think that you can expect some of these things to probably be examined, and it's a matter then of proving what did you pay for. Again, we fall back to the presumption that any payment to an employee is taxable. So if you have no documentation that it met one of the exceptions, it's going to be considered. And a lot of times stipends may actually just be, and you may choose to do it and just tax it to get over that administrative burden, but it depends how many employees and the dollars of which one might cost more for you.
Sure.
So the last category on perks here is really just stepping back again to that total rewards package, moving outside of specific business expenses that you're reimbursing. But given the competitive landscape, are employees using the benefits you offer? If not, do you know why not? What else might you want to offer that would be more attractive that the employees would value? For example, pre-tax transportation before isn't super valuable if people aren't coming to the office anymore. If you had an on-site gym before, do you want to start offering outside gym memberships? And you might, but it's a different tax consequence for an off-site gym than an on-site gym. So definitely considering that overall package. Student loans are shown here. We do have a 5-year treatment that you can reimburse student loan payments up to $5,250 tax-free per employee, which might be really attractive to your employee base if you haven't explored some of those. So I guess just to recap, the compensation and benefits from the federal tax perspective is really an overall sort of total rewards picture that all employers should be looking at and what should change, or if you have made changes, what are the tax consequences of those?
Sure. No, a lot of options for employers to consider as they're trying to attract workers either to their organization or to come back into the office in a more of a hybrid format. But before we move on, maybe Dominique, any observations on geographical pay from an international perspective you'd like to share?
So we are seeing a number of employers who are adjusting their compensation, considering local compensation factors such as cost of labor and cost of living in the location where the remote worker is now located and working. When geographic base pay is implemented, it seems organizations are considering smaller downward adjustments for employees who have moved to lower cost jurisdiction. However, there is currently a desire for companies to create fair geographic policies that do not impact retention or disrupt the talent pool.
Thank you for sharing those observations. A lot of things to consider when it comes to compensation and benefits. But let's move on. I think we're going to have our next polling question here. Let's see. Has your company taken action to meet U.S. payroll obligations for employees working and or residing in another state? First answer, yes, we've made the required payroll adjustments for employees temporarily working or residing in another state. Yes, we have made payroll adjustments to account for employees temporarily or permanently working in new states. No, we've not made any adjustments, or D, we're uncertain. So we'll leave the polls open here for about a minute or so, but as you can probably see, we're going to be transitioning into U.S. state and local topics here, and I know Brian's chomping at the bit to say something. It's been 26 minutes, and he hasn't had a chance to talk, and he's going to get some time here in just a few minutes. So we'll leave the polls open. We're at about 90% answers. We'll leave them open for like 10 more seconds, and then we're going to switch to state and local tax considerations in this remote environment. All right, so 3, 2, and 1. So kind of an even split. About half have made adjustments to account for remote working, and about half are uncertain or have not made any adjustments. So I think that's good background for us moving to state and local topics. So Brian, maybe just to start out, there's a lot to unpack here from a state and local perspective, but what issues have you been seeing clients facing with having employees working in remote work environments that are outside of where the employer's headquarters is located?
So, Jeremy, in answer to that question, I think it's important to look at this in two tranches. The first is the kind of temporary, we're running around trying to fix things of 2020, when you had all of these different mandates: stay at home, don't stay at home, can't go to the office, this has to be closed. And ultimately, during that time period, there were a small number of states, like 15 almost, that provided some temporary state tax relief to basically say, hey, these are extraordinary circumstances, and in these kind of extraordinary circumstances, we're going to let you kind of have the same tax result that you've always had, regardless of where your employees go. That was not as widespread as everybody expected, but ultimately there's probably a good argument that in these types of circumstances it would be fundamentally unfair for a state for 2020 to really go after you hard for having an employee who is temporarily there, especially in circumstances where the governor mandated that they stay at home. That's the first tranche. Guess what? It's over. The pandemic is done as far as state taxation is concerned. As far as, say, my younger than 12-year-olds are concerned, probably not. But in terms of how state tax looks at the pandemic, it's over. There's no more temporary relief. All of those provisions are gone. As far as the states are concerned, you have employees in the state. You're doing things in the state. Ultimately, those are going to be viewed as if you are purposefully doing them in a non-emergency situation, that you have made something that would be considered a permanent change. And I saw in the first poll, which was very interesting, that around 30% of the respondents had said that ultimately what was it? They weren't doing anything. They hadn't made a decision yet regarding how they're going to finalize their employment, whether it's going to be remote, hybrid, something like that. Well, I'm sorry to tell you all, not making a decision yet is actually a decision as far as state taxes are concerned. You've left an employee there. You've allowed them to be there. It's not an emergency. It's real now. And what does it's real now mean? All right, there's a couple different things. One, you got nexus problems. If that employee is not a salesperson and the only thing they're doing is trying to solicit sales of tangible personal property, you probably don't have 86-272 protection anymore if you had it. You certainly have nexus for sales tax purposes, for income tax purposes. Regardless, a lot of people are sitting there saying that you have these kind of Wayfair nexus thresholds for sales tax. You don't reach the threshold, don't worry about it. Guess what? The Supreme Court in Wayfair did not get rid of physical presence. You got an employee in the state, you're done. You're collecting and remitting tax. Same thing is true for a whole bunch of other issues. But the key thing of importance to understand is that now, regardless of what you've decided, if you've got employees in a state, that's potentially a trigger for all kinds of issues: income tax, withholding, sales and use tax, property tax. If a state has a business personal property tax and your employee has your computer sitting there, has a printer, has a desk that you paid for, you might have a personal property tax filing responsibility at the local level. There's all kinds of things that got triggered. 2020, those things didn't get triggered because of temporary relief or exigent circumstances. 2021, you got no excuse. And that's where we stand.
Well, let's maybe go a little bit deeper on a couple of those topics. So let's start with withholding taxes, right? Each state has its own requirements with respect to withholding taxes. What guidance can we give to employers where they have folks working in a different state than their withholding is currently being done?
So the normal state tax answer right now is it depends. And I'll need to look at each state. But the short of it is to give you at least some guidelines to work by. In general, the way that state taxation works from a withholding perspective, you withhold based upon where your employee is working. That's where you, the employer's withholding responsibility is. If that happens to be the same place where they live, huzzah, your tax withholding is the same as their tax responsibility as a resident. It's supposed to match up. They get a refund probably at the end of the year and everything's great. Unfortunately, that's not always the way that it works. And post-pandemic, as you move to a hybrid or remote workforce, it's really, really not the way that it works. Some states have something called reciprocity agreements. Under those reciprocity agreements, you only withhold in the state of residence. So, for example, there's this kind of D.C., Virginia, Maryland agreement. I live in Maryland. I work in D.C. I don't have D.C. withholding because of that agreement. If I was an employee of my firm rather than a principal, the firm would withhold tax on me in Maryland only. Those reciprocity agreements do exist. They always have. They have existed for a very long time. There aren't any new ones post-COVID, but I suspect that this kind of more mobile workforce is going to create some impetus for more reciprocity agreements. We'll see if that works out. But ultimately, in the absence of those reciprocity agreements, there's two possibilities. Possibility number one, withhold where the employee is doing their work. That's the possibility that exists in most states. For example, if an employee is working in Virginia or Maryland or whatever it happens to be, that's where they're resident, that's their home office, that's where you withhold. Some states, however, have a rule called the convenience of the employer rule. Under the convenience of the employer rule, the way that it works is that you withhold at the location where the employee is working only if their work activity is being performed at the convenience of the employer or for the convenience of the employer. If it's just because the employee wants to be a remote employee and work from home, those states would say, hey, that's for the convenience of the employee, and you still withhold at their office of assignment. So, for example, New York is one of these states. Employee lives in New Jersey, they're working from home in New Jersey, they have their office in New York. It's still their office of assignment. Their manager works there. Their cards still say that that's where they work, that type of thing. You're still withholding New York on them. And then they've got to deal with New Jersey separately. And those are kind of the possibilities that are out there. And you have to be able to navigate those states. Now, mind you, there are some changes going on. For example, early in COVID, Arkansas became a convenience of the employer state, and then late in COVID, they rolled that back and got rid of it. So you got to watch that, and it's still a moving target, but right now it's fairly set.
So I'm taking away, it's very fact specific, right? And it is an evolving landscape as states are wrestling with what's the best way to administer tax policy, right? Going forward in a newer environment.
I would certainly agree with that.
So just got a question in the chat that really relates to what the topic we're talking about right now. What's your thoughts on, an employee's occasionally working in another state? What goes from occasional to we need to look at this a little bit more seriously, right? I'm working for a couple weeks, a month, the summer. When do I need to really start? When does my antenna need to go up as an employer where someone's working remotely for a temporary amount of time for their convenience, most likely?
This would be easy if the federal government had or would pass the Mobile Workforce Act or whatever version of it is moving around right now. That really hasn't happened. Under that proposal, there would basically be a 30-day number where if you're not working in the state for more than 30 days, you don't have to withhold in that particular state if what you're doing is some temporary employment there. But that doesn't exist. Instead, what we have is this mishmash of state rules. And these state rules could be as little as 1 day. Some of them are 15 days. Most states are silent. Ultimately, what you're going to look for is my employee there? Are they working on my behalf? Did I send them there? If they are, I should know that because in my reporting system, I should have something that tracks where they are, where they do their timesheets and they say, I'm doing my work from Ohio today instead of Pennsylvania. In those circumstances, we should be withholding them using a day's method. Withholding on them using a day's method, except to the extent that it's not for the business's convenience and the business is located in a convenience of the employer state. So there's, again, moving parts there. The rules are either a blank or a variety of different numbers of days in. It's one you have to navigate based on the facts and circumstances. Though I think most people are kind of crossing their fingers and holding their breath and hoping the federal government actually does something to move forward mobile workforce. We thought there was a chance last year, and that just didn't happen. There was a temporary relief, but that was it. Jeremy, you're on mute.
All right, now can you hear me?
There you go.
I didn't know I did that. So really, it's understanding your facts and really having a process to gather your facts so that you can deal with the myriad of issues that comes with state income tax withholding for employees. But maybe
Absolutely.
let's switch now to Nexus. You mentioned Nexus too. So these remote employees, maybe being in different states than where they had been. What are some surprises? What are you seeing in companies dealing with how that impacts their Nexus footprint for income tax reporting?
So from an income tax perspective, probably the most surprised, if you will, are the manufacturers and sellers of tangible personal property. These are the businesses that are taking a public law 86-272 position where basically what they're doing is they're saying that all they are doing in the state is they have a salesperson, they're soliciting sales of tangible personal property, and they're shipping that tangible personal property into the state from a different state. In those circumstances, the federal law says the state can't subject you to tax, even though you have Nexus. That whole landscape changes when your in-house counsel moves to one of those states, or an R&D person moves to one of those states, and they're working from home there. Any kind of back office person, really, somebody from operations, as long as they're not involved in sales, in solely sales and activities ancillary to sales, you could wind up losing your 86-272 protection. I think that's the biggest thing from an income tax perspective. The other piece to the equation, though, is that you may be in a circumstance where you feel you don't have economic presence in the state. Some states have announced factor presence rules where you have to have like $1 million in sales in the state, or 500,000 or whatever the threshold happens to be. You haven't reached that threshold, so you're not paying tax in that state. Well, you send it, there's now an employee living in the state, that threshold goes out the window. You don't worry about it anymore. You worry about the fact that you have a physical employee in the state doing things on your behalf. Some states actually also have a payroll and property factor presence type of approach, and it's typically like 50 grand. California, it's up to 62, 63, right around there. In those circumstances, if you have a low compensation employee in the state, maybe you get under that threshold. But most states kind of look at those thresholds as a guideline, and that constitutional nexus still applies. And under the Constitution, you have one employee in the state, and you are purposefully availing yourself of the state's market. That's enough. That's enough to suddenly have a filing responsibility. And if you've never had that in the past, and you're not used to having to file in 30, 40, 50 states, you're in for a real surprise, particularly if you went into telling your employees, hey, go ahead and be remote, without actually thinking about it and saying, ooh, maybe we don't want them to go there, or maybe it's not a good idea to tell them to spread out wherever they want to go, and maybe we need to be more focused and directed.
I think those are great observations, and again, it goes back to the key tenet here of the conversation is that understanding your facts and having a way to accumulate them is extremely important to be able to manage your exposure and your footprint. So I think those are great observations. Maybe before we move on, Anne, any perspective you want to add when it comes to benefits and remote workers working in different states jurisdictions. Is that something that we need to also keep an eye on?
Yeah, definitely. I would say not necessarily from the tax perspective, but from a state law perspective, some of these benefits are different. So a couple of examples, your health insurance plan, does it meet certain state law requirements of where your employees are actually now? Another one is some states actually have rules on remote workers and certain expenses you have to reimburse them for. If you haven't looked into those types of things, again, not from a tax perspective, but from a legal perspective, you might have some benefits exposure there.
I think those are great thoughts. So let's move forward. And
Jeremy, if I may wrap with one thing, I'd like to maybe give just one final word of advice on here. I think the key from a state and local tax perspective is that you are letting your employees be flexible, be deliberate about it. States are trying to attract these remote employees. There are process controls you have to have in place. There's compliance that's going to have to be done. If you're not deliberate, don't model it out. Don't focus how your business is going about it. There are a lot of traps that you could fall into and a lot of opportunities that you could miss. I think that's key for this entire presentation. With Anne, with Dominique, with me. If that's the takeaway, I hope that everybody gets it.
Thank you, Brian. Great summation. So with our polling question here, how successful has your company been with managing remote work requests? As we just talked about, understanding your footprint is very important. So first response, excellent. We have a great process in place to manage the corporate risks. Second, good. We're in a good place, but we still have room for improvement. Not so great. This webcast comes at the right time. And then uncertain. So we're about 50%. We'll leave things open here for about 30 more seconds. Please click on your response so that everyone can get if they're seeking CPE, they can receive that. So we'll go 10 more seconds here at about 90%. All right, 3, 2, and 1. So we can see here some 20% of the folks on the webcast feel like they're in a great place, about half in a good place, and then 13% not so great. They've learned some things as we've gone through it, and others are still kind of evaluating, how this applies to them. So let's talk then about work arrangement approval, and let's Dominique, let's do this from an international perspective. Companies are still in the process of developing their approval process for remote and virtual work arrangements. As you've been consulting with clients, what are the key issues for employers when they're implementing their methodology for international work arrangement approval?
So for many of us, as we said earlier, remote working has really become our new normal. So the willingness for an organization to support personal requests really need to be balanced with an understanding of the key issues, which are, is there a legal presence? What about the employment rights, payroll obligation, the permanent establishment risk, the right to work, and the employment benefits? So these key issues will need to be prioritized and balanced with a company's goal to retain their employees or making their employees feel valued and engaged in their work. So at a higher level, organizations really need to maybe first review these 5 key issues. First, the legal right. An employee with an employment contract issued in one country, but working another one on a permanent basis is likely to raise questions regarding employment rights. So you really need to perform a full assessment in order to avoid any challenges later on. The second key issue, I would say, is around tax withholding. A remote working arrangement will likely trigger tax liability in the country and the country of work, and even a double tax liability if we have cross-border duties. There also may be a requirement to file tax return and complete registration to remain compliant. So, and then as part of the tax withholding, you also need to address the social security tax liability. As you may, you need to determine where does the social security liability exist, and do you have the correct paperwork in place? Another area which is linked to tax withholding is around payroll obligation. You, as an entity, an organization, you need to ask yourself, what are the requirements for payroll both in the country of employment and overseas? Such obligations need to be checked to ensure that your reporting is done accurately and your business remain compliant. Also, as we discussed throughout these presentations, a significant issue is to review the permanent establishments. You need to review whether the activities of the employee is giving rise to a corporate tax presence. A cell generating role on behalf of one entity, for example, may unintentionally create tax implication for the business in the new location, as well as for the employee. And then the final item, which I mentioned earlier, is the right to work. The first thing is, does the employee have the correct immigration status in the country where he intends to work? So in conclusion, there may be an appetite for many organizations to say, I really want to retain this employee, and I really want to go ahead with setting up an entity in a remote location. And that is a costly exercise for one individual. It may be worth exploring if the business is expected to grow in that location in the future. So this approach is also facilitates hiring future employees in the long term and work for a long-term investment perspective. So a long answer to a short question, Jeremy.
Oh, no, there's a lot of things to consider, and I think you did a great job summing it up. And I think this is a great slide, and for those that want to leverage, this sample, you can obviously download the slides and be able to use this to help facilitate some conversations. But thank you, Dominique. So one more polling question here, and we're going to be moving into policy framework. Are you tracking where your employees are working from? Yes, we're actively tracking where our employees are, and we'll continue this process post-COVID. Yes, we are tracking our employees' work locations only if it's expected to be long-term. No, we are planning on tracking going forward, or uncertain, still evaluating. So we'll leave the poll open here for a few seconds. As we're answering the poll, Brian, I got another question for you that came up in the chat box, and I think it's in the chat box, and it's something that I think is pretty common. The hybrid work arrangements are happening all the time, and let's talk about cross-state hybrid work arrangements. Working in the office a couple days, maybe 2-3 days a week, and then working from home in another state 2-3 days a week. What should employers be thinking about in those types of arrangements?
So are we just talking about employers, or are we also talking about employees at this point? Because there's a little bit of both, particularly depending on how far away we're talking about. I mean, we've had a circumstance where you had an individual in an office on the East Coast, and they decided to move to let's just say Texas, because it's a no individual income tax state, and everybody likes to pay no individual income taxes. And the person was in a C-suite position and moved to Texas, had a house in Texas, kept an apartment in the other state, and spent about 185 days in the state where they were originally posted. Well, you have all these questions of, did they change their residence? If they did, are they statutory residents of the state where the office is? And are they essentially subject to a double tax? Which state has to grant a credit for the tax paid to the other state? From an individual perspective, you got to make sure you pay attention to that, because you could find yourself in a bad position. From a business perspective, it's kind of the same thing, where depending upon how long you're in any one state, generally speaking, that's going to determine how much you withhold in relation to that state. Now, there could be some other issues, particularly take as an example, if you have a C-suite individual, the CEO, and the CEO goes to a cost of performance state and they're spending their time there and they negotiate the sale of a major intangible. Well, that cost of performance state is going to want a significant piece of that sale of the intangible based on their apportionment approach, because the CEO is negotiating the deal, signing the deal, doing it all from the other state. If you're switching back and forth, you better make sure that you're paying attention to state taxes, because you want to do the right things in one state and the right things in another state so that you don't wind up increasing your tax burden. And that's a completely new and different state of mind than what we would have had before. Yeah, you have jet set people, they're moving, they're going to different places, but they're there for a day, they're there for 2 days. But when you're splitting time, what you do at each location based upon that split really matters.
Thanks, Brian. And I think as we go into the answers to the poll question here, we can see, about 40% very actively tracking where their employees are. 25% doing it in a long-term context, about 10% no, and about a third evaluating how this all applies to them. So I think transitioning into our last topic is our policy framework. Most employers had a remote policy framework in place, probably pre-COVID. But now that the workforce expectations are shifting and such, maybe Dominique, I'll ask you this question. Why is it important for organizations to revisit their policy given the changing environment?
I would say by now all employers have determined that applying a traditional telecommuting policy to their workforce is not going to work. So it's therefore important that you have in place a policy that clarifies which worker is going to be eligible and the duration of the arrangement. Appropriate approval process will need to be put in place in order for an organization to manage any surprising in terms of additional costs and new tax or legal obligations.
I think those are great observations. Anne, anything that you want to add from your perspective?
I think what I would just directly say, I think it's obviously been pretty apparent as we've talked this morning, but to just call it out, tax obviously can't do this in isolation. This is an area that's HR, it's legal, it's IT, probably even for tracking and tax that all sort of have to come together to wrap your arms around this for an organization in most cases. And we purposely sort of ended with policy here, I think, because to sort of steal Brian's words from earlier, you are making decisions even if you don't know it. So best practice is actually spend some time thinking about that and get it into a policy. The employer does carry a lot of the risk here if you're not asking the questions. Certainly, employees may not always give you the information, but if you've never asked the questions, you've probably got risk.
And to jump in, just normally I wouldn't suggest having me as the last person speaking, but that's a different issue. What I would say at the end of this, when you look at all of these things, if you don't have a policy, you actually have a policy, and it's burying your head in the sand. And let me tell you, in this situation, you can pretend nothing's happening, but the states, the federal government, international governments, they all know it's happening. Whatever's happening is happening. Your employees are all over the place. And they have the ability to find out where. Credit card statements, airline usage, electric bills, all kinds of different things, all the things that they're reporting to you that you might not be thinking about. All those things can lead to a trail that gives state departments of revenue, federal IRS, international tax authorities the ability to figure out what you're doing and how. So if you don't pay attention to it, you will be caught by surprise. And that is the last thing anybody wants. When I was sitting in your shoes running a state tax department in a big company, the last thing I wanted was to suddenly be told one of my entities was doing something I had no clue about. In these circumstances, be deliberate, keep your head up. It sounds like I'm talking to a wide receiver going over the middle. But honestly, be deliberate, keep your head up, look at all of this stuff. Make sure you understand it and that you are taking advantage of the gifts that the states give you. If it's credits and incentives, wonderful. And make sure that you're managing the risks. And you can't manage those risks unless you have a policy in place and the means and will to follow those policies. Jeremy, I'm going to hand it back to you to wrap up if you can. If not, I'll move to the next slide. All right, I'm going to go to the next slide. This is our final polling question. Would you like to talk more about this topic with an RSM professional? A, yes, B, no. I talk about this with RSM professionals all the time. It's how we figure out how all the details of what's going on and how we can help you. Hopefully you all are either already talking with us or it's something you'd like to talk about in the future, simply because there's a lot going on. What's happening right now is not a static thing. It's not static from the perspective of your company. It's not static from the perspective of the law. And being able to navigate things is a deliberate process. It takes step after step after step. With that, I believe I hand over the baton. Everybody enjoy the rest of the conference and have a great morning.
Thank you so much, Brian, and thank you to all of our presenters today, and thank you to our audience for joining us. Our next session will be at 11:30 a.m. Eastern Time, The Hunt for Revenue, Hot Topics in Tax Controversy and IRS Enforcement. We hope you'll join us for that, and we hope you join us in the meantime in our networking lounge for all the presenters from this event. We'll be talking further about this topic. If you have met CPE criteria, you may download a copy of your certificate by visiting the Certification Center and clicking the download icon. Be sure to save a copy to your computer in the next few minutes before we conclude our event. Thank you so much for joining us for RSM Tax Summit Week.